have a full crowd here. We also have some new attendees for our first webinar for 2019. So we're going to go ahead and get started. I want to say hello and Happy New Year to everybody. And welcome to our online webinar, The Secrets to Generational Wealth. Our goal during this webinar is to teach you about some uncommonly known financial structures and strategies that help put you and your family in more control over your income and assets for generations. This webinar will be roughly about 1 hour, so if you're online, please follow along with our visual slides and visit irs.com and take notes via paper or pen. As a presenter, we'll be presenting some of the information from that website. The information you hear tonight's webinar can be summed up in 2 famous quotes. The first one, the secrets to success is to own nothing but control everything. That's by Nelson Rockefeller. And the second quote is, it's easier to fool people than to convince them they've been fooled. That's Mark Twain. Tonight's speaker is Trust and Foundation Specialist, Mr. Larry Conner. Larry's education, extreme knowledge of this topic is second to none. And our mission and passion is to educate business owners, entrepreneurs, and families about these uncommonly known wealth strategies. It's my extreme pleasure to introduce to you Mr. Larry Conner. Larry.
Well, thank you, John. Well, we embark on a new year. We get an opportunity to share the information that every business owner, every individual that's intending to start a business, or you currently in a business. The information here is to help you to be able to select the correct form so that you can receive all of the benefits that is available to you as an individual that runs a business. Now, if you don't have a business and you're on the call, one of the things that you will learn is that there 50% of what I'm going to say is going to apply to you as well in the area of asset protection and and estate planning. So that part would apply to you, and I'll bring it to your attention as I get to that part. But as a rule, the presentation is going to be geared toward those individuals that want to start a business or in business. Now, having said that, one of the things I want to start with is the thing that after 9 months of reviewing the information and so forth, 9 months of calling the IRS, 9 months of going to the IRS office, all of that to validate what I'm about to present to you. The last thing that I looked at that made me decide that this must be the real deal is when I went to irs.gov. So when I went to irs.gov, I wanted to know what did the IRS say about starting a business. So having said that, John, we're going to go to the first slide. And I don't want to bring to your attention that I said the first thing I wanted to do is find out what it is that the IRS say about starting a business. So if you're looking at the screen right now, this is the irs.gov website. Now, it looks a little different now because they've changed the format, but the search window is still the same. So if you put in business structure in that search window and then click, you will get to the next screen that gives you a link that goes into what the IRS says about business structures. So as you click that link, now you're at what the IRS says. Now, this is the most important part of everything I'm about to say, because if I was telling you this information and this part here is not true, it does not apply, then it would be all for nothing. So I want to draw your attention to what the IRS says about business. It says when beginning a business, you must decide what form of business entity to establish. Now, if you're looking at this page here in the middle, it shows sole proprietorship, partnership, corporation, S corp, and limited liability. And then the next sentence says your form of business determine which income tax return form you have to file. Let me say that again. Which income tax return form you have to file. I've read this many times over the years, but that did not stick with me because I was going to form one of the companies they say here that's the most common. And so each one of those file a 1040 tax form. So if you choose any one of these forms, it defaults to a 1040, and you never know what the other income tax form is. Now, if your third sentence says the most common form of business are the sole proprietorship, the ones I just mentioned, and then it says the limited liability company is the business structure allowed by most states. Now, if I was doing this according to how I would present this information instead of the way it's listed here, I would start with the last sentence first. And if you're looking there, it says legal and tax considerations enter into selecting a business structure. That's the first thing I would say. Then I would say choose the business entity. But here's the problem. The uncommon business entities are not listed on this screen. So you got to do a little research and find out what is the other income tax return form. So this is the part that changed everything. So in finding out that on the next slide, that the 1041 is the income tax form, is the other income tax form. So up there in the search window, once again, you can enter 1041 in that search window, and then you want to click on it, and it'll bring you to another link. The link, as you click on it, take you to a 1041 tax form. Now, on the left-hand side is the form that defaults with all the other business entities that are there. Now, on the right-hand side is the 1041 tax form. These are the only income tax return forms they have. So there are only two. So the question is, which one do you use? Well, 99% of us use the 1040. But for those that are informed, use the 1041. And I'm going to make that pretty evident as to why as we go on in the presentation. One of the things I want you to know about these forms is this. On the left-hand side, the 1040, you can have as many pages as the accountant thinks is necessary or unnecessary. The 1040 tax form client last year had 200 pages. 200 pages. Now, here's the thing with that 200 pages. That says that when you sign, you're signing saying that you understand where all of the numbers come from and you agree with it. And your accountant or CPA signs off. And as he or she signs off, now you're responsible for all of the information. Now, if you're like most of us, that's not true. And the reason I mention that is to show you the difference between that 1040 and the 1041. See, the whole purpose of a tax audit is to make sure you're not overstating your income, excuse me, and understating your income and overstating your deductions. So on the 1041 tax form, there are only 2 pages, whether you make $50,000 or $50 million, and you're looking at that form. And as I go through this, you will see just how easy that form is to know where all of the information comes from. So as we go to the next form, next page, we're going to start with the information as to why we use an LLC as the entity or statutory entity of choice. Well, you have your choice. You can use a C Corp, but for those of you that choose a C Corp, there are 3 ways by which taxation can occur. You can have corporate tax. If you founded the company and you're an employee, you're going to have employment tax or W-2 taxes, wages. You're going to have tax on any dividends or share that you may have that's producing. So 3 possible ways you can be taxed. Can you have a trust as a shareholder in a C Corp? Absolutely. But let's go to the S Corp. The S Corp is a pass-through entity. It's a pass-through entity, but one of the things that we must remember in an S Corp is that it is designed that the owner in an S Corp must have a reasonable salary, which means W-2 withholdings, and the difference is pass-through. For those of you that are taking 100% pass-through, you probably ought to bring this back up to your accountant or CPA, okay? Now, having said that, the LLC is the entity of choice because it does not have a tax return. It does not file taxes. It is an entity that, whereas the members or the owners of the LLC file taxes. So here that you're looking at, you're looking at an LLC. Now, one of the things I want to talk to and make mention about here is that why a multi-member LLC. First of all, I said that it is not subject to filing income tax, only the members. Now, for those of you that have LLCs and you're the only member in that LLC, that the IRS looks at that as a disregarded entity. All that means is that they do not look at it from a tax standpoint as a limited liability company, but you file tax as a sole proprietor. Well, when it's filed as a sole proprietor, then the income is taxed to you. Well, the whole purpose of this call is so that you'll understand on how to own nothing but control everything, as John stated at the beginning of the hour. So I'm just going to take you through the LLC here, and we're going to, and then we're going to move on from there. An LLC, in this example, generated $1 million in revenue or income. It had $500,000 in expenses. Now, in that $500,000 in expenses, that included everything associated with business, okay? W-2 income, and by the way, a member in an LLC is going to receive a distribution, and it's not going to file as an S corp. Let me say that again. An LLC can file as an S corp, or it can file as a partnership. Doesn't mean that it's a partnership. It means that it's an entity that has two owners that file taxes as a partnership. Okay, I'm gonna come back to that later. Now, so we have $500,000 in expenses. So the difference is the taxable income of $500,000. So someone has to pay the taxes on that $500,000. Now, if you are a single member LLC, you're going to pay self-employment taxes of 15.3% on that $500,000. Now that just comes right off the top, and I'm pretty sure that doesn't sound good to you. And for that reason, your accountant and CPA set you up in an S corp, understandably, but understanding also that it can file as a partnership, and the partner that is going to be assigned here is one that they have not been exposed to in their training. So let's just do this one more time. $1 million came into this business. $500,000 was in expenses, and $500,000 is taxable income. So just like you have articles of incorporation, which tells exactly how the company is run, what's going to happen with shares, how you bring in new people, how you dissolve the company, all of those things. Well, the entity that is in the part that tells about what happens in an LLC is called the operating agreement. In the operating agreement, it tells the percent of ownership of the profit or net income for each one of the members or owners. And in the operating agreement, you can determine and make whatever that is. It can be 75, 25, 50, 50, or in this example, I use 98-2, okay? For the purpose of illustration. And I use 2% to let you know that it only matters based on what your agreement says. So in this example, we're going to take the $500,000 and we're going to distribute it based on the percent of interest each one of the trusts has. Now, if you notice, it says business trust 98%. 98% of that 500,000 is 490,000. Now, you, as one of the members, you receive 2%. 2% of the 500,000 is $10,000. Now, some of you may have a question is that, well, how can I live off $10,000? How does that work? But the beauty about this is that the business trust, you are the trustee of that business trust. And you are also the owner or control of that $10,000 or that 2%. So in your operating agreement, there should not be any discussions about having an argument with yourself, you as trustee, and you as also the 2% member. Now, the trust is a legal, separate, taxable entity. Now, as we go to the next slide, I'm going to show you how this works in terms of the LLC distributing the income. So in the example, where it says you, 2% of that 500,000 is $10,000. So that would be your taxable income. Now, let's just talk about self-employment tax. Remember earlier I said that self-employment tax was 15.3%. My question now is, are you concerned about self-employment tax at 15.3% on $10,000? Probably not. So, and that is the amount even before you get to Schedule A, as you're looking down on the slide, Schedule A deductions, which include 30% of the adjusted gross income can be donated to a charitable, as a charitable deduction. And so thus reducing that $10,000 any further. But we'll talk about that later too. Now, as we go to the next slide, it kind of shows the total distribution. So here's how it works, guys. You got an LLC. This is your company. Now, at the end of the year, your CPA accountant is going to prepare a 1065 form. It's a reporting form that goes to the IRS that tells them that the company made X amount of, in this case here, $500,000. It says there were two individuals that received K-1 forms. One is the business trust, and the other would be you personally. And those forms go to you, K-1, and the K-1 tells you what you have to file taxes on, your income tax return. Remember we said there were two? Well, the business trust files a 1041 tax form, and you would file a 1040 tax form. So let's just explore exactly what that business trust looks like on the next screen. When we get to the next screen, we see that this is a business trust. And by the way, I use the term business trust to let you know this is the trust that has a relationship with the LLC. I call it business trust so that you know that the difference between the other trusts I'm going to speak of. So this is business trust, and we're going to identify the others as we come to them. So that income goes to $490,000 goes to the business trust. And if you would look at this box as a 1041 tax form, because this is all of the information that actually goes on that form. And I'll share that with you in just a second. But in this example, we're going to use $100,000 as expense. Every dollar that leaves the trust is a deductible expense to the trust. And the reason that it is because you don't own any of the assets, you merely control it, which means you make a decision for every expenditure. Every expenditure is tax deductible. Now, I just used this $100,000 as an example. It could be $490,000, it could be $510,000, it could be $600,000, or it can be zero. The point here of this illustration is show you how income and expenses work. So the difference is $390,000, okay? Now, you are going to, as trustee, you're going to pay taxes on that $390,000, or you're going to take a deduction for it and distribute it to another entity. And you're going to do that via a K-1 form. Now, while we are on the business trust, let's just go to the next slide. Oh my goodness. On the next slide here, it shows a 1041 tax form. And the 1041 tax form is that form I showed you earlier. So what we're going to do now, I'm going to show you what needs to be completed, okay? So as you're looking there, it shows income, expenses, and distribution. So if you look at the top on the left-hand side, it says complex trust that's highlighted. It shows also the name business trust. That's the name goes there. The EIN number, which makes this a separate taxable entity, goes to on the right-hand side. Now, all we have to do now is complete the form. Now, if you notice on the left-hand side at the top of the page, This page is designed for 9 entities to use this form. So you're only going to complete the sections that are applicable to the business trust. So if you look at the income section, you're going to put 490,000 on line 9. Line 9 is the place where you put total income. The IRS is not interested at this point on where the income comes from or who it comes from. They want to know from what category it comes from. If you notice, it says interest income, income from royalties, income from real estate, portfolio income, ordinary income from businesses. So whatever that add up to, in this case, we're assuming that is going to be $490,000. That's on line 9. Now, if you notice the $100,000, it's on line 15A. This amount would be expenses that are deductible to the business trust. Now, once you take the difference, that works out to be $390,000. Now, I want you to pay attention to line 18. Line 18 is the line that has the $390,000 on it. Well, the IRS says refer to your governing instrument, and your governing instrument says that you make the decision as to what percent of distribution there is. You can distribute part or all to another taxable entity. In this case, you as trustee, you're going to decide to distribute 100% of that income. Now, if you notice on line 22, that says 0, because if 490,000 came in, 100,000 went out, and then $390,000 went out, that is 0. So 0 tax or 0 tax liability. Now, one of the things I want to share with you at this point is that if you look down at the bottom of the page where it says sign here, once you sign there and date it and send it in and fold it up and put it in an envelope, and this envelope will be to the Internal Revenue Service, and it will be addressed to Ogden, Utah. You fold it up, put it in an envelope, and you've just completed your 1041 tax form. Now, the reason I'm saying that is because that $490,000 comes off the trust bank statement. If you made $490,000 in deposits, that's income, then that's the amount that should show up here. So you are very comfortable that you're not overstating, you're not understating, you're using the exact dollar amount that was deposited in the account as income, and this is all of the income that was received by the trust. Now, when you look at the debit side, you see all of the debits or withdrawals for expenses or use, etc. That falls on the debit side. Debits represent expenses, and that is what's shown on line 15A. At this point, you can go to sleep at night knowing that you have completely filled out this form and you know exactly where every number has come from. So now, when you get ready to do send your paperwork in, then you automatically know that I am good with this. I know exactly where it comes from, and only thing that's left or remains now is for them to process it. But if you look at the bottom of that page where it says net income, I just give a little summary: 400,000, 100,000 expense, net income 390,000. Well, if you notice that $390,000 is going to be distributed to another entity, and so that other entity is going to be a business trust. I'm sorry, a family trust. Now the family trust, but the family trust is now let's see. Now this is let's see now. John is trying to bring something into you to your site right now, and this is kind of the overall view of what the trust flow is. Where it says fiduciary trust, that is the trust that is called a business trust. Then there's the family trust. That's the trust that is the beneficiary that receives the information from the donations from the fiduciary or the business trust. Now, it also has a family charitable trust, and each one of these trusts has a purpose and a point, and ending up in the private family foundation. But if we go back to the business trust slide, and Let's see. And we're going to go down to the next slide right there. We show where the business trust, and only thing I want to bring to your attention about this slide is that two things. On the right-hand side are icons of some of the things you can purchase. Anything, cars, phones, airplanes, buildings, it doesn't make any difference. Everything that they purchase is an asset to the business trust. But that $390,000 is the next part of this slide. I want you to know that it is distributed to the next trust via a K-1 form. And that K-1 form says that tell the IRS no taxation to the business trust is zero because the income has been given to another entity, which is its beneficiary, which is the family trust. So if you notice here, the family trust has $390,000 with the income, and I just use $100,000 once again as expenses. It can be whatever it is. It could even be zero. But for the point of illustration, I used $100,000. Now, if you look on the right-hand side, those things are considered assets, those icons. You know, the house, life insurance, you know, medical, car, groceries, house you used to own, the car you used to own, all of those things that are now titled to the trust that used to be titled to you. And here's where I want you to understand that once an asset is titled to the trust, that you no longer own it. So if your home is quitclaim deed to the trust, then you don't own it anymore. Even though it may have a mortgage, if it has a mortgage, you're still obligated to the mortgage company to make the payments, et cetera, contractually. But it has been deeded to the trust so that trust can do all of the things that you used to do in relationship to making a mortgage payment, in relationship paying for repairs, paying for insurance, paying for everything associated with that property because it's owned. And I'm harping on this right now because when after this conversation is over, for those of you that are here for the first time, you'll go and tell your friends that I just heard one of the greatest things ever, that I can have a trust that paid my personal expenses. That is not true. You cannot pay your personal expenses, but can the trust buy assets? Can it buy assets that you get an opportunity to use? Once you give it to the trust, it belongs to the trust. If the trust bought a car, can you use it? Absolutely. Can a trust buy groceries? Absolutely. Can a trust buy diapers? And I only use diapers because someone asked me that the other day. Yes, it's not illegal for a trust to buy anything except for those things that are illegal. Now having spoke about assets, now the difference there is $290,000. That $290,000 now is going to be taxed. Now, it's going to be taxed at 39.6% if it stays in the trust. Now, the business trust and the family trust assume that this is at the end of the year and we're doing our taxes, okay? Or you can assume this is at the end of any 1 month. So now, here's what happens. Just like the business trust made a distribution of $390,000 to the family trust, the family trust is going to make a donation. Now, if you notice where it says income donated $290,000, when it makes the donation of $290,000, it has a zero tax liability. Now, remember when I showed that 1041 for the business trust, that you put that information in on the various lines and then you sign it and send it off? You do the exact same thing for this and you just completed the 1041 for the business trust. Now, remember, each one of the trusts is its own separate entity, own separate taxable entity. And it has an EIN number, or it has an address, it'll have a bank account. And you as trustee would be responsible for facilitating the filing of the taxes. Now, the family trust makes its donation to the charitable trust. And that's on the next slide. Will show that the charitable trust just received $290,000. Now, if I want to draw closer attention to this, notice on the right-hand side of that $290,000 is 39.6%. That is the tax rate for any money that is left in the trust. Let me take that back. Not any money, any income, because you can deposit $100,000 in the trust, and that's an asset. That's not income. You can have $250,000 in a trust, but only 50,000 is income. So we're only accounting for the income. So income that's left in the trust at the end of the year is going to be taxed at 39.6%. So here, as we go through this example, we show $100,000 as expenses, and the 100,000 went to buy some of the things on the right-hand side, those icons, and that left $190,000. Now, you are now going to donate that to a 501c3 because that's the contract for the Family Charitable Trust. The governing instrument says that it must donate the remaining net donations to a 501c3 or a nonprofit. Now, when that happens, you have just created a zero tax liability, and so in doing so, you have three trusts that are interconnected, that has zero taxes. $1 million came into an LLC, and now $190,000 is going to be donated to the 501c3 or the private family foundation, which is on the next slide. Now looking at this next slide, I want you to write this down. And maybe one day when I think about it again, I will add this slide in here. But I want you to know the difference between the two types of foundations that are out there. There are operating foundations and there are non-operating foundations. Now, if you notice here, right under the word private family foundation, you see non-operating, and which is completely different. So I want you to write operating foundation. And to the right of that, I want you to write public charity. Public charity. Now, as a public charity, what that means is that the public charity is an operating foundation. And that is a foundation that usually movie stars, athletes, and entertainers have, which means that they donate money over there, they pick a cause, and then it must be used for that purpose, and the dollars, for the most part, have to be able to be used by the end of the year. There are some exceptions, but that's primarily the purpose. However, when we talk about the non-operating foundation, it is a 501c3, and it is a nonprofit when set up properly. Now, what happens is that $190,000 came from the charitable trust. And coming from the charitable trust, what has happened now is that it has $190,000 there. And in the foundation, what it must do is, unlike the operating foundation, it can use, well, it is obligated to spend 5%, it's called the 5% expenditure rule, to grow the foundation. Spend money to do something that's going to grow the assets within the foundation. When I say grow assets, if it bought a life insurance policy, it is going to increase the assets in that foundation. Yes, and it can make the monthly or annual premium, whatever it is. Any administrative costs, any costs or expenses within the foundation, when they are used, that they are also amounts that can be used to satisfy the 5%. Let me kind of give you an example as to what we're seeing here. You're looking at 5% or $7,000. So $190,000 is there. Spent 50. So of that 140,000, using the 5% expenditure rule, 5% of that $140,000 is $7,000. So you have to spend $7,000 to grow the foundation. Operating foundation has to distribute all of the money, and it must distribute 5% to another outside of the foundation. But all of the money eventually leaves the foundation in that year. So here you control everything. Now, as we look at this page and we see the icons to the right, the foundation can do everything that the trust can do, except for it cannot vote, and neither can the trust. Those are the only things that these artificial entities cannot do, okay? At the bottom of the page, I just listed some of the entities that are public charities or operating foundations. So I'm going to move a little, and as we go to the next slide, we're going to see a little bit closer as to what is within the private family foundation. So to the left, as you see donating entities, all that means is that these entities can donate to this private family foundation. On the right hand side tells the duties of the trustee. And the trustee's duty is to receive donations, is to make investments, it's to invest or have equity ownerships in other companies, to grow the assets, create endowments, and it will have expenses, and also to abide by the 5% expenditure rule, which is the things that grows the foundation. And here I indicated that you are the trustee. You are the trustee in each one of the entities. You're the trustee in the business trust, the family charitable trust, and the private family foundation. Now, some of you may say, well, gee, how can that be so? Well, there are, it is no different than you being the CEO of 5 different corporations. And to give you kind of an idea, Lyndon B. Johnson had over 200 trusts, and Rockefeller had over 2,000. So there is no limit to how many trusts you can have. Now, the other most important thing, I think the most important thing on this page is the arrow where it says files a 990 PF. See, an operating foundation will file a 990. Now, please, people, do not get lazy. This is a 990. Do not get lazy when you're talking to people and say it files a 990. Because if you do, then what you would be telling them as to what I said would be absolutely incorrect. So you must say a 990 PF. As a 990 PF, the forms look almost the same, but it's completely different in terms of how it operates. So 990 PF. Now, the beneficiary of the foundation is the community good. And what's the community good? Unlike the operating foundation, you can have several different things that you have point of interest in that you want to help. You may want to do something with teens and golf. You want to do something with Habitat for Humanity. You may want to do something with the SPCA. You may want to do. You can have several different interests with the private family foundation. However, with the operating foundation, you can only have one. And sometimes you may ask yourself, why is it that the Red Cross, why is it they don't do this? Why is it the Ronald McDonald, they don't do this? Because when they are set up as a public charity, it is set up for a specific purpose, and that's what they have to honor. Now, having said that, I'm going to get into a little example as we go to the next slide. And the next slide should show you a little bit more as to why a private family foundation. So if you're looking here, let's make an assumption with this illustration that $1 million was donated to this foundation. And if you notice also, 133,000 came from the family charitable trust. So the trust now has assets of $1 million. But let's say that you as trustee decided to buy interest in an apartment complex, or apartment building, etc., rental property. It doesn't matter. But in this example, I use apartment buildings. And the reason I use apartment buildings is because it's real estate. And with real estate, and if it's investment property, it's going to be income producing, which means that there'll be rents at $5,000, $100,000, $50,000, $100,000 a month or a year, whatever that number is. Well, that income comes back to the foundation tax exempt. The foundation does not pay taxes on it. Now, the other thing too is that real property in the foundation is not subject to property tax in most of the counties in the United States. Now, also, assets in the foundation are not subject to lawsuits. So these are some tremendous things that we're talking about, and you, the trustee, have control of it. But let's take it a little further. You just spent $800,000, but you have $200,000 left. So you decide that you're going to loan part or maybe all of that 200,000 to an LLC, to a business trust, to a corporation, to an individual. It doesn't make any difference. You can loan it to an LLC that you are a member of. You can loan it to a business trust or a family trust or a corporation that you may be a part of. Because you're a trustee, you're not, you do not own the assets of the business trust, nor do you own the assets of the foundation. So double dealing is out of the question. You can only double deal when you are the beneficiary, or I said the beneficiary, that the money is coming from the foundation to you. It is coming to something that you control. It's not coming to you. Now, here, let's just take the loan out of the picture. And let's say now it's just the 200,000 there, and you're not making any loans. Remember, I spoke about the 5% expenditure rule. Well, here is where you would that $200,000 net donation, 5% of that, which is $10,000, you have to spend to build the foundation. So what does that mean? Let's say, for instance, the trustees have two trustees, and they both bought policies, life insurance policies, and they were both $5,000 a year. So that's $10,000. Well, right there, you've already satisfied your 5% expenditure rule, because when you pass, the foundation is the beneficiary, and whatever the life insurance value is comes back to the foundation, and these dollars are left there for your successor trustees to come in and control based on what your wishes are in the trust minutes of the foundation. Now, some of the other things that can be used is that the IRS allows for family retreats. Family retreats, sometimes people call them vacations, but the IRS calls them family retreats. The IRS suggests, and in their publication, they suggest that the family and trustees get together and talk about what it is they want to see done, and they think it's an opportunity that is helpful and helpful to the growth and the health of the foundation. So if that meant going to abroad and that cost $10,000 for the trip, that is an expense to the foundation. So that's just to mention a couple things, and we can talk about that later. The purpose of this call here is to let you see there is another system that files the other income tax return form and allow you to control all of the dollars. So now, as we go to the next slide, we're going to try to bring it all to a close now. Okay, so this is a series of interconnecting trusts that's attached to a private family foundation. The first three trusts are they are artificial people that need someone to run it. Each one of these trusts can do the same thing, but we use them in different ways. It's no different than having three different pairs of shoes. You know, it doesn't matter whether you have a pair of dress shoes, tennis shoes, and flip-flops. They were designed for specific purposes, but at the end of the day, they're still shoes. So here, at the end of the day, these three trusts are still assets trusts. They each have its own bank account, its own address, and its own tax ID number, making it a separate taxable entity. Now, you as trustee, I'm sure you guys have seen around town sometimes when you see these signs that say estate sale. That means these are individuals that did not set up their affairs properly, and the house, the cars, the money, everything that they had now, the furniture, everything being in storage is now being sold so it can pay off estate tax. Well, what we do is that we show you how to take those things that would have been yours and put it in the trust. So any event that something happens to you and you're the trustee, there's no death tax, no inheritance tax, no probate, no attorney fees. Your successor trustee steps in and take over as though you were still there. So when this is set up, it becomes a federal organization. not subject to the same rules as some of the other 79 different types of trust. The other 79 were designed for a specific purpose. You know, the revocable living trust, the spendthrift trust, the charitable remainder trust, the REIT trust. You know, they were designed specifically. But the thing is that when you have this series of interconnecting trusts, it operates internationally, which means that not only does it operate internationally, but these three can do everything all of the others combined. So you have a series that's set here that can do everything that you need it to do. Now, the foundation is the catch-all. Now, see, the thing is that when we talk about taxes, you can look at it as being social capital. Now, if the IRS assessed the tax on you and you pay them, you can look at it as you giving them social capital involuntarily. But in this structure here, the IRS says that we're going to let you decide on how you're going to use that social capital. When they give you that option by using the trust and the foundation in this series, you're able to do what they do not want to do. And they'll tell you they do not want to be in the social business. They do not. So that's why this year they have allowed up to 60% donation of your personal income to a foundation or to an operating foundation, and take a 60% deduction against your income. That's in an operating foundation. So that's how much they do not want to have to get involved, and they're going to give you a big discount to do it. But you got to give away over up to 60% of your income that you have no control of it once it gets there. Now, here, it's a little different. The money that comes into the foundation, you control it. The money that comes in each one of these entities, you control. So as we go to the next slide, we're going to come full circle. We have an LLC that generated $1 million. It had $500,000 worth of expenses, and that left $500,000 of taxable income. This LLC was a multi-member LLC, and it had 2 members. Now, notice I did not say partners. I said 2 members. When you say partners, that means something else. It has 2 members, and one received 98% of the income and the net income, and the other received 2%. And each will file its respective income tax return form. So, and also note that it will not file as an S Corp. It will file as a partnership. That is very important. It will file as a partnership. Now, in doing so, the LLC will produce a K-1 to the business trust and to you personally, which you will file a 1040 tax form. Now, that business trust, it will take all of its legal lawful deductions, and the dollar amount that's left is going to be distributed to the family trust. The family trust will take all of its legal lawful deductions, and the difference is going to be donated to a family charitable trust. The family charitable trust is going to take all of its legal lawful deductions, and then the difference is going to be donated to a private family foundation, which is a nonprofit, which is a 501c3 once we get it set up. Now, it is going to take those dollars, it is going to create assets. It's going to buy assets. It's going to invest. It can invest in the stock market. It can buy life insurance. It can buy cars. It can buy land. It can buy real property. It can do anything. It can buy anything, just like the other 3 trusts and just like the LLC. The only difference now is that 5% of the net income, I should say the net donations in the private family foundation, is going to be used to grow the foundation. So having said that, that is the full 45-minute overview, and I think right now I will kind of sit back and open the lines for questions, if that's okay, John.
Yeah, most definitely. I've muted out individuals because we had some background noise. So if you have a question, please unmute yourself and ask your question. Oops.
How you doing? Good evening.
Good evening.
Good evening.
Great presentation. my question is, my partner, me and my brother are partners in real
Okay.
estate. We buy and hold, we buy and flip.
Okay.
At the end of the day, would these different trusts be set up? Would we have to have individual trusts, or at the end of the day, can we have a family foundation that would
Okay.
most of us as trustees?
Here's the way I would suggest it. Okay. First of all, I would never have anyone as a trustee with you except your spouse. Okay. And because any partner that you have should be set up within an LLC, so that each partner would let me go back. Each member, you would call them a partner, but I would set up it as an LLC with two owners, and you and your brother. Now your brother would have a trust, and you would have the trust. So if you're looking at this example where it says 98% business trust, there will be two business trusts there. You guys would be totally utilizing exactly what this call is about. When John said own nothing, control everything, if both of you had a trust here, that means you would not have any personal income. All of the income would be coming from the business trust, the family trust, and the family charitable trust. So look at, and let's say you guys are 50-50 partners. So, or should I say 50-50 members? So that means 50% or $250,000 would go to the trust that you control, the business trust you control, and 50% would go to the trust he controlled, which would be $250,000. So yes, you both would have a series of interconnecting trusts, just like we have here.
Okay.
And because if you both are married, then what you're doing is that if you're married or have children or trying to set up for a legacy, you want to create your own with your family. Now, can you both be trustees in a trust? Yes, you can. In fact, in this LLC here, you both can be members of the LLC with the income going to the business trust. In the business trust, you both are trustees. So as trustees, you decide what happens to the income. Remember, you don't own it. So if $500,000 came over there, so how would you distribute it? How would you divide it? So you can't say this is his and this is mine, because remember, you don't own it. So if you say this is mine and it's 250,000, and then but he spends the whole 500,000, can he do that? Absolutely, he can. Should he do it? Probably not, but he can. So that's why I say that a trustee has all of the powers. So if there are two trustees, they have equal power, and they do not need the consent of the other trustee. So in that case, you and your brother set up an LLC as a multi-member, and you both have your respective trusts. That would be the ideal way.
And then also too, Larry, on the fix and flip part of it, they get advantages on capital gains with the foundation. Does that work for them with that strategy?
Well, see, here's the thing. Good point, John. Here's the thing. When you're in the real estate business, here's a couple of things you can do. And I'm going to start with the foundation. And see, when you work with us, we will help you decide on the strategy, whether or not the property is bought in the foundation or is bought in the trust. But if it's bought in the trust, what happens is that you buy the property in the trust. It's an expense against any income that may have donations that's already in the foundation. And now you bought it. Now you're going to have to go to Lowe's or Home Depot and buy the material. Call the contractor in for cement and blah, blah, blah. Well, you submit your tax exempt letter, and now you buy those repair parts without taxes on it, without a federal tax or state tax. Okay, so now when you sell that property, the gain comes back to the foundation tax exempt. You take that money and go do the same thing. That's what's called when I say building the foundation, that's what you're doing, building the foundation. Now, on the other hand, depending on your scenario, if you're if you decided that you want to do it on the trust side, you can do it out of the family trust. You can do it out of business trust, but the family trust allows you an opportunity. That's why I would suggest putting all passive income, all investment income. So, and you also can keep it personally, depending on whether or not you needed depreciation and depending on not how long you keep the house before you flip it. There may be some that you keep as investment to generate rental income. So to answer your question, you can put it in either one, foundation, trust, or individual. But there's definitely some advantages by having it put it in the foundation.
Okay. Thank you.
If I didn't answer your question, please ask it again because I want to make sure I get that answer.
You totally answered it.
Very good. Any other questions? Well, John, it seems like I outdid myself. Either I was very clear or it was as clear as mud.
I think you were very clear. I can say that. I can say that when you do a presentation, it's very clear.
Yes, sir. I confirm that.
Larry, you were very clear. I thank you both so much. People, this is the time to ask any questions so you can get them answered.
Absolutely. And please understand too, I know you've heard it a million times before, there's no such thing as a dumb question. Well, here in this house, on this call, there's truly no dumb questions either.
And we also know you know what you don't know as well, getting this information. So if there's questions that might pop up and you want to jot those down, please get those to the individual that sent you to this webinar. We can get your questions answered. We know it's a lot of information, especially for someone who's never been exposed to this information. Like Larry said, when he first got started, it took him, was it 9 months? You said
9 months. 9 months. Just double checking everything.
And go ahead.
No, I was going to say, and so the benefit of it is that we learn. If we have to make the mistakes ourselves, it takes us longer to learn. But it's easier to double check the information somebody have given you so that your learning curve will be faster. And so if you have questions where the information came from or where to find it on, and that's why I primarily use the IRS.gov website, because look at it this way. The IRS says, choose the income tax return form you want to use. And they give you both on their website. And they both have different rules. If they didn't have different rules, there would be no need to have a second one. They would only be the 1040, but they have different rules. So if they tell you that you can prepare your taxes yourself, and I'm sure that some of you may have already prepared your taxes before by yourself by going to the IRS.gov publication or going to IRS and getting a publication and going line by line and completing your 1040. Well, no different on the 1041. There's a publication and instruction that tell you how to complete it line by line. So if they tell you how to complete it line by line on the 1040 and it's okay, then if they tell you how to complete it line by line on the 1041, that should be okay too. Otherwise, they will be receiving a whole bunch of lawsuits. So they're telling you and they're giving you the information, and all you have to know is how to use it, where to go to find the information. And we have accountants and CPAs, and I've been doing this for 11 years. I think John is what, 6, 7 now, and time flies. We have having a lot of fun, sharing a lot of information. Our clients are anywhere from $50,000 a year to $25 million a year, and we help them to structure themselves so that they can have full control of the dollars that come into their control. So the person that invited you to the call, ask them to give you a questionnaire, send you a questionnaire, and it'll get back to John, and we can arrange a one-on-one. And if all you need is just a questionnaire completed and an answer, we can do that too. The questionnaire tells us exactly what you need for the most part. Some of you need two business trusts. Some of you may need two LLCs. Some may need to convert from an S corp to an LLC. Some need to have the LLC to file as a partnership instead of a corporation. All of these things we help you with. And we also help you with setting up and creating your operating agreement. That's one of the things that's needed when you do your LLC. So we'll help you with the business strategies, and at the same time, we'll show you also some of the things that allow you to grow your business with some of the things we do in our workshops that we have 4 or 5 times a year.
Hello, is anybody there?
Yes.
Hi, my name is Rich. I'm in Connecticut. How are you guys doing?
Wonderful, Rich.
It was a great presentation, and I just
Thank
want
you.
to thank you for giving us so much information. Please forgive me. I'm pretty much of a novice to most of this stuff. So I just had a question as far as charitable contributions or being able to bless people.
Yeah.
Is it better to do it through a trust if you want to bless someone with a gift, or is it better to set it up as a separate charitable contribution, or what's the best way to do that, would you say?
Well, there's a couple of things, and I'm glad you asked that question because when you have a foundation, a private family foundation, you can provide grants to individuals, and a grant is just that. You provide the funds that they do not have to pay back, nor is it taxable to them. In an operating foundation,
Great.
a public charity, you can't do that. And there's some means by which you can do that on the trust side as well.
So if you set up the family foundation, you take the taxable liability off of them as the giftee, and you would take the taxable liability off yourself as well.
Exactly, and you can do that to some extent also on the trust side. So it just depends on how much and what it is you want to do. So whatever the dollar amount is, then that will determine which side. But at the end of the day, you'll get a chance to make that decision.
That's fantastic. I didn't even know that could existed.
Yes, sir. It sure does. It sure does. It sure does.
Well, I truly believe this is what was spoken of in the Old Testament when they talked about the wealth of the wicked has been stored up for the righteous.
Absolutely. Absolutely.
That's great.
Like,
Very well said.
And then, of course, and you know what? The thing about it is that for decades, that we've been working, and for decades, we've made money. But think about all of the taxes that we paid. Think about what could be used, those dollars could be used for if we had known this when we first got started. If we'd known this when we were in business, if an individual had to pay $10,000 a year in taxes from his business, is it worth it to him to be able to keep $100,000 in his pocket to control over 10 years? And the reason I asked that question is because one of my clients said, well, this is only for people that make over $400,000 a year. And I said, well, I believe if you ask someone that paid $10,000 in taxes, if they didn't have to pay it and they could afford to get the product, I would ask them, would they rather the $100,000 in 10 years stay in their pocket or send it to the IRS? I believe they would think they'd rather keep it.
That is so true. That is so true. I mean, you hit the nail on the head. Because I love what you said about the IRS doesn't want to be in the what's the terminology used? I think it was social
capital. Because
yeah,
people
exactly. Because if you had the option, I mean, I have a friend of mine down in Florida, and very quite wealthy older gentleman, and he said, "Listen, I'm glad I found out about this stuff because I don't want to fund illegal wars, and I'd rather have my money go into. If I have the choice, I'd rather send it to St. Jude Hospital,
And and the thing about it is that, and then see, so when people say, well, this too good to be true. Well, see, the thing about it is that when this was designed, it was designed for us to file a 1040 and for the elite to file a 1041. If this just came into play in 1981, that the group of individuals spent $28 million challenging the SEC ruling that said that individuals, if you didn't have $30 million combination of income, assets, and investment capital, if you didn't have that, you didn't have the privilege to know or to be presented with this information. So that challenge from 1981 to 1984 and $28 million, they got the right to be able to present this to the public in a teaching format. That's why you never heard me on a talk show. You never heard me on Facebook or any of those things. And 100% of the people I work with have come from referral. People sharing and referring.
Because it's funny. I was reading about George Clooney, and he wanted to help 11 people and help them when he got started in business, in show business. So he gave them all $1 million. But I guess he never knew how to set this up, because it said that he didn't want them to get hit with the tax liability. So I guess they said that on that $11 million, he ended up getting taxed at about $4.7 million, because he didn't know any of the stuff you guys are talking about tonight.
Right. There's a way to do that. Absolutely a way.
Well, I'm so grateful I met you guys tonight. I really feel blessed, and I'm looking forward to speaking to you further, because this is really very enlightening tonight. It was one of my concerns. I want to be able to bless a lot of people, but I didn't want to see them getting whacked on the tax side. And on my end, I didn't want to see them taking those tax dollars and avoid it and be able to put it into helping other people,
Absolutely. The thing about it is that the more we are blessed, the more we can help other people. With us setting ourselves up with structures like this, that means that, when I give my fee structure, as 20% of tax liability, minimum $25,000. So, but a person that makes $100,000 a year may get turned off because they don't have $25,000. But see, that's not what I'm saying. I'm saying fill out the questionnaire so that I can see how it benefits you. I have a minimum because I have millionaire clients that don't pay taxes, and they should not pay the same price as someone that makes $100,000. That's why I say it that way.
That's right. Well, again, I don't want to tie up all you guys' time. I'm sure other people have questions, but I just want to thank you for spending the time with us tonight and really giving us some great information.
You're very welcome.
Okay. Have a good night.
You too.
Thank you.
Bye now.
All right. Any more questions?
Well, you know what that means, John.
I sure
It
do.
means that I can go have dinner.
Well, have a little for me too, Larry.
I usually don't have dinner before these calls, and so when they end, that's when I have my dinner. It's a little after 9 Central Standard Time, and of course it's a little earlier on you guys out on the East Coast. No, West Coast. You guys, West Coast. A lot of you.
We got all time zones covered here, so we're
all time zone.
Yes, we do. And I want to thank you, Larry, once again for coming to this call and presenting this information to our guests. This is our first one for 2019. We are offering some discounts and some specials for this first quarter. At least I am, for the people that came to this call that was referred through me for for the taxation year for the first quarter. So some people can get their stuff set up early in the year. There's some benefits of getting your complex trust set up, because they start the day they're funded. And the funded word doesn't mean actually getting a bank account and putting money in there. It's basically when the documents have been notarized is when your trust system is set up. So anything that's happened after that can go back retroactive. The foundation has better benefits where you can go retroactive from the end of the year back to the first of the year, but at the same time, you will be able to get the benefits that you see on this screen right now. So I want to thank everyone for coming to this call. Once we do, or this webinar, we have these periodically. I'm kind of glad we waited a little bit because we have a good turnout tonight. So we will let you know again when we have our next webinar. We did have a request for this with the large groups. I want to thank Valencia for that as well. And we'll go from there. So Larry, once again, go have some dinner. Thank you, ladies and gentlemen. Good night and God bless. Thank you.
Thanks, everyone.
Bye-bye.
Good night now.